For many individuals that want to start building credit, but they also want to earn points, potentially getting that premium credit card with Southwest may not be the right fit, because even credit cards have like an algorithm that they must follow to pre-approve you. So if you're only starting, start with a basic one. Start with a college credit card, maybe even a secured credit card.
Welcome into the Dynamis podcast this week, guys. We have a really informative episode. This week, we're talking all things credit, and this is a really, really applicable episode to a broad spectrum of people. Whether you're just getting started on your journey, just getting started investing, are interested in purchasing your first home, purchasing anything, whether you're young or have been around the block a few times, there's a ton of unanswered questions involving credit, our credit report, why it matters, and how we can use it to our advantage to really get where we want to go. And I brought in an expert to talk all things credit. I partner with Danny in my mortgage origination business. I send a lot of clients that aren't quite ready to purchase over to her. And just through organic conversation, her and I were having conversations about credit. I was asking her, questions that I don't even know. I'm in the industry. And I just decided, you know what, let's just get you on the podcast and let's answer these questions for the public in a open forum so that whatever benefit I get, everybody else is going to get out of it too. Because I know if I'm learning something, I guarantee you're going to learn it as well. And so, Danny, welcome to the studio and thank you for coming by.
Of course, Tim, thank you so much for having me. I'm so excited to talk about all the things that just people don't know about.
Can you just give us a brief introduction? Who are you? What do you do? And how did you get started doing this?
Yeah, so I'm Daniela Torres. I'm actually from Colombia, and moving to the U.S. I'm a U.S. citizen. I've lived here for a very long time, on and off, moved to different countries, but I think I'm just so passionate about education in general. Having knowledge is power. And from a personal experience, when I moved back to the United States, I didn't know anything about credit. It's so different from what I'm used to from the other countries I've lived in. So I realized that there was a great opportunity for me to educate myself and then share the knowledge with others. I've been working in finance, since I'm 29, and I've been working in finance for almost 11 years. And it's just the fact of knowing how to help people use their wealth, use their finances. I work with Uqual, and Uqual's a loan readiness platform that provides education, information about how to budget, how to save money, how the credit bureaus may not always have correct compliant information. And if you don't even know what's on your credit report, how does that impact you as an individual in America?
Yeah, absolutely. So the biggest impact I see, in the mortgage origination side, let's say you're wanting to buy a house, for example, you're just getting started. You come to me and we go through your file. I do your income. I run a credit report. One of the first things I do is I run a credit report, and the credit report tells me a couple things. Number one, it just spits out a number, which is like your playing card score. That tells you how good of a borrower are you. Does the bank think that you're a good borrower or not a good borrower? And what really is associated with that is risk. Are you more of a risky investment or are you less of a risky investment? But it also spits out information about your payment history and what debts you have. And, the biggest thing I see is, especially right now with affordability, is when interest rates are climbing, you want to have the cheapest interest rate possible. And the way to do that is by having a better credit score. And there's so much mystery about how do I know what my credit score is? What do I have to do to improve my credit score? Because ultimately, I want everyone to have the best pricing available. And by pricing, I mean, I want you to have the lowest interest rate possible so that I can keep your mortgage payment as low as possible. And credit is just like this hidden thing that people don't fully understand. And that's why I wanted to bring you in to talk about how can we start to remove the veil and really understand what our credit report is, how to improve it, and how to utilize it.
Yeah, it just really sucks because think about it, Tim. What's the first thing you see when you go off to college? It's a Wells Fargo booth, a US bank booth. It's all these banks and financial institutions telling you, open this credit card. You need credit. Do this, do that. Here's a line of credit for $1,000. They don't tell you, hey, make on-time payments, set up auto pay. If you don't pay this credit card, it's going to hurt you. if you close your first credit card, it's also going to hurt your credit scores. Like, there's just so much that the system unfortunately lacks of in regards to educating you. You deserve to know how to manage your credit, and you deserve to even know what your credit score is. Like, I think it's wild how so many consumers, how many individuals in America don't even know what their credit score is, and they're just logging into Credit Karma, which, oh my God, don't even get me started on Credit Karma.
Well, let's talk about Credit Karma.
Yes. Credit Karma is crazy. So I'm sure most of your listeners here are, part of Credit Karma. It's a system. It's a free application. Anything that's free, you become the product. So first, Credit Karma is using your information to sell it to other vendors. The reason why you see that you're pre-approved, or the likeliness of you being approved for a specific credit card on their platform, it's because they're getting paid when you click on those things. Credit Karma it's a good algorithm. Like, it's a good way for you to monitor your scores, but the credit score that you see on your Credit Karma is nowhere near the credit score that you're going to pull as a mortgage lender.
So why is that? Most people that come to me, they're like, hey, here's my credit score. I checked it on Credit Karma. And I usually tell them, like, well, that's probably in the atmosphere, but it's not a super accurate depiction. But almost everybody that comes to me has their credit score that they believe is accurate from Credit Karma. So what's the biggest difference between Credit Karma scores and your actual score? I guess, what's the biggest difference, and how is Credit Karma generating a credit score versus a guy like me who's running a hard credit inquiry?
Yeah, so Credit Karma is not a lender. Credit Karma will never let you borrow money. They do have a platform where you can save money, but they don't have a platform that allows you to borrow money. So that's very important to understand, because when we think about credit scores, there's different algorithms. If you apply for a credit card, that's a credit card algorithm that the system will generate for your credit score. If you apply for an auto loan, and almost anyone can get an auto loan. You can have a 520 credit score, Tim. You can still qualify for an auto loan. The reason for that, if you don't pay back on that specific vehicle, you're going to wake up one morning and your vehicle's gone. It didn't get stolen. They repossessed it. And yes, they'll come find you, even if you move out of state. They're going to get back their money. They're going to sell that vehicle. So anyone can get an auto loan, but not anyone can get a mortgage. The system that is utilized to, generate that FICO score for mortgages uses a higher risk information. Like, if you don't pay back on a $1,000 credit card, what makes a lender think that you're going to pay back on $500,000 mortgage? Like, the risk is significantly higher. So there's different algorithms, but Credit Karma is using their own algorithm, which in the mortgage industry, you're looking at the last 7 years of credit history. Credit Karma says, if you make on-time payments for the last 2 years, you're a perfect borrower.
Oh, I see.
I think you would agree with that statement. Yeah.
So Credit Karma is pulling borrowing data from the last 2 years of borrow history. Is that correct?
Yep. To utilize your payment history, it's the only last 2 years.
And when you said FICO, just for everybody listening, if you're not tracking, what is a FICO score? FICO score is just another word for your credit score. It's an acronym, FICO. It means the Fair, Isaac, and Company. I don't know why or where that comes from. Maybe you know, but FICO is like your official score. That's the score that I would pull as a hard inquiry as a mortgage lender, correct?
Correct. Yes. So Credit Karma uses Vantage.
Okay, got it. So the data just isn't as good. So it's kind of in the neighborhood, but it doesn't give us a full history. So let's go back. You're 18 years old. You're in college. You have no credit history whatsoever. There's this Wells Fargo booth. How do we start building a credit score? What things contribute to this score?
There's a lot of different factors that can impact your credit score, such as credit cards. Like, if you're 18, you don't have a credit card, you may not even be approved for one because, you don't have enough history to reflect that you're able to apply for credit cards. Like, there are so many credit cards out there. There's the Southwest credit card, there's an Amex credit card, there's the Chase Sapphire. Those are premium credit cards. And for many individuals that want to start building credit, but they also want to earn points, potentially getting that premium credit card with Southwest may not be the right fit because even credit cards have like an algorithm that they must follow to pre-approve you. So if you're only starting, like start with a basic one, start with a college credit card, maybe even a secured credit card. The system does not yet trust you to apply for those premium ones. For those, like investors, they probably have the fancy credit cards that give them 5 times as many points for traveling, for, using money in different ways. But if you're only starting now, the best way it is to get a college credit card or a secured credit card.
But what types of things contribute to your score? Like, one day you don't have a credit score and all of a sudden the next you do. How do we start, where does this magic credit score come from? I'm trying to unpack the layers of what is the foundation? When does it start? And what things contribute to our score, either being up or down? What builds on these things? What types of purchases or revolving lines impact our score?
30% of your credit score comes from your credit cards. So off the bat, if you don't even have a single credit card open, you're missing out on 30% of points.
So wow.
Other thing is length of credit history. Yeah, it's crazy.
So 30% of your overall credit score is credit cards or a revolving credit line.
Correct.
Okay. And then what else is it made up of? You said length of borrowing history.
Yes, so that's 15%, which this is a topic that I do want to emphasize on in regards to the length of credit history. It's an average. So let's pretend I have, which I actually do, a 10-year-old Victoria's Secret credit card. That's my one and only account. But I haven't used it in a long time because I just don't go to Victoria's Secret anymore. I use Amazon because it's a day 2-day shipping and it's so fast. So I love Amazon. But if you have a Victoria's Secret credit card and then all of a sudden that's my one and only account and I decide to close that today, I lose that length of credit history. So I go from 10 years of length of credit history, which ideally the mortgage FICO system wants you to have at least 7 years of credit history. So if I close on a credit card, I lose all of that history that I've built and I start from zero.
That's a really good point.
Same goes with opening new credit cards. Yeah.
So that's why you made a comment in the beginning of the episode. If you close out your first credit card, it has a negative impact on your score, and it's just because it's impacting length of credit history. That's why they tell you to not cancel credit lines, right?
Correct. Especially the old ones.
So you want at least 7 years of borrowing history, which makes sense because you said that's 15% of the overall credit score. But I wonder, so you made the point about your Victoria's Secret credit card and you have 10 years of credit history. What if you also at the same time opened a Southwest card? The same time you opened the Victoria's Secret, you had an equally long credit line with Southwest, for example, but you only canceled one of those cards. Would that have a negative impact on your score?
If they were both opened on the same day, my length of credit history wouldn't impact because the math or the science behind it of the 15% is the dates that you open the account divided on the amount of accounts that you have open. So if it's 10-year-old, I eliminate one out of the equation, no impact, right?
Yeah.
Now, if I open a credit card today, I have 10 years of length of credit history, my Victoria's Secret. Today, I open a Southwest credit card. I now have 2 credit cards, 10 years, 0 years, literally maybe a month, divided in 2. My length of credit history just decreased to 5 years.
I got it.
Thanks myself.
So what if you had multiple credit cards? I know we're going down the rabbit hole, but I just want to ask all these questions personally for my own information, selfish information, because I guarantee it's helping other people too. Let's say before you open that Victoria's Secret credit card, you had that Southwest card we were talking about, but we opened it a year prior and we canceled the Victoria's Secret credit card. Would we still have a negative impact? I think the answer is going to be yes, because we're reducing the overall number of credit lines, but probably not as big of an impact as canceling both the 10-year or whatever.
Correct. Yep.
Okay.
That is correct.
So generally, what kind of impact do we see when we cancel a credit line like that? How much of a blip on the movement up or down does that have on our score?
It really depends on the other accounts you have open. So I have my 10-year-old credit card, but then I opened an auto loan 5 years ago. Maybe, the impact will depend on what other trade lines I have open. So it's really going to depend on the case-to-case scenario.
Okay, well, let's go back into what makes up our overall credit score. So we have 30% coming from revolving credit lines, credit cards. We have 15% coming from length of credit history. That puts us to 45%.
Yes.
What other things make up your score?
35%. Yeah, 35%. So this is the most important one, is your payment history. If you're new to credit, you only have 3 months of building your own credit, and all of a sudden you forget to make a payment, you're showing the system that in the 3 months you've built credit, you can't even repay back your debt. So that's going to have a significant impact if you default on a payment so early into building your credit. But then if you pay on time every single month on all of your trade lines, each monthly payment that you make on time will positively impact your scores.
We're going to jump back to this one because I have some pretty specific questions in regards to borrowing history. So just remember things like charge-offs, delinquencies, serious delinquencies. We're going to come back to this because this is something I see all the time. Every credit report I pull, at least lately, I seem to uncover something along these lines. So I want to come back and talk about these impacts specifically. But that brings us to 80%. We got 30% credit lines, 15% length of credit history, 35% payment history. That's 80%. We got 20% more to go.
Yes. So the other 10% comes from diversifying your portfolio. In a perfect world, and this is why it's so rare to see someone or an individual with an 850 credit score, that's the highest score you could possibly have. It's because not everyone has a diverse portfolio, meaning you need to have at least one open credit card, one mortgage, one auto loan, one personal loan. So you need to have a little bit of everything so you can show the system that you have the ability to pay on auto loans, to pay on a mortgage, to pay on a credit card. Like there's no product you don't have the ability to pay on time.
That is so interesting. I never, ever knew that I needed. I mean, I always knew I needed a credit card and I knew it was helpful to have an auto loan, but I didn't know I needed an auto loan, a mortgage, an open credit card, and a personal loan. Interesting. So that
a little bit of everything. It doesn't mean, just to clarify for all of the listeners, I'm not saying if you do not have an auto loan open or a personal loan open to go ahead and open one. Let's clarify. You don't need that. Every case is very specific.
Yeah, at least not until you buy a home first, man. That is the biggest deal killer. Is I get into a credit report and somebody wants to buy a home loan, or they want to buy a home and they need a mortgage, and man, I'm seeing dual incomes, and each person has a car loan, and each car loan's $600, $700 a month. That's a mortgage payment right there, and I have to hit you with that debt, and man, it's huge expense. So if you want to buy a car, wait until you buy a house first, and then you can buy a new car. So that brings us...
Yes, and it really sucks because it happens often. Like people just do that. People just open auto loans, not knowing, or co-sign for individuals not knowing.
So co-signing. We're going to talk about co-signing in a minute because I have a bunch of questions about co-signers. So let's round this out. We're at 90%.
Yes.
Let's bring home...
Other 10% is new credit. So new credit means how many applications, how much of new credit are you acquiring? And the system may not necessarily like that, like inquiries. And we'll talk about that later down the road too. But new credit is, like you were saying in regards to the auto loans. Maybe you don't need to get so many new products or get in so much debt before doing something, making a huge purchase like a house, right? So new credit is the other 10%, where they may not want you to have too many open new accounts within a short period of time, because the system is about patterns, behaviors. If you acquire too much debt, it thinks you are potentially not liquid enough to sustain yourself with what you have, and you need new trade lines to survive.
That's very interesting. So if I went out and opened new credit lines, it could have a negative impact on my score if it's outside of my norm. So this is something that I just did. Okay, I have a couple of high balance credit cards and I use them in my business. So I invest in real estate, I have a business, and sometimes I put debt on these credit cards. I always pay my statement. Every time the bill is posted at the end of the month, I always pay it in full. But I noticed that my score, I got a notification from Wells Fargo, my score fell 15 points this month. And I was like, what? Why did my score fall 15 points? The only thing I did is I opened up two credit lines. There's a Wells Fargo Sapphire card, or I forget the name of it. And it's 21 months, no interest. And as an entrepreneur, I'm like, free money. I'll take that money all day long. And so I opened up the credit card, and we have a big trip coming up in October. And so I also opened a new Alaska miles card because we're going to book flights. We're going to pay it off anyways. I might as well get the points on it. So I opened 2 credit cards this month, which is rare because, who's opening 2 new lines of credit? And I saw a 15-point decrease, and it pissed me off.
Let me ask you this. Did you match them? I know you're going to pay them back, which, that's what investors do. You get a new line of credit. You do 18 months, no interest rate. You max it out so you can invest it in different things you'll be doing. But did you max it out, Tim?
No, I didn't max it out, which is why I want to talk to you next about utilization. So I've always kept my credit limit. The reason I opened 2 cards is because I didn't want to put everything on one card because I wanted to stay under 20% of the overall limit, which is why I opened a second line. So for example, that Sapphire card or whatever it is from Wells Fargo, it was a $20,000 limit card, and I decided I wanted to keep it under $4,000, but I needed that for the business. I knew the flights were going to be close to $2,000 because it were, a big trip. And so I was like, well, I don't want to get a ding on my credit score. I better open another credit line, and I got a ding anyways.
Yeah.
So let's talk about utilization. How much credit do we want to use? If a company gives us a line of credit, how much do we want to use to make sure that we're not taking a hit on our score?
Yeah, and this is something that is very unique to understand because Credit Karma specifically, it shows your credit utilization as a total of all of your limits versus all of your balances. But that's not true. Each credit card has to be below a 30% utilization before it starts penalizing you.
Interesting.
Each credit card, it's not a total, it's each.
So it's below 30%. I said 20, but it's actually 30% utilization.
Yeah, but for mortgage inquiries and mortgage purposes, the system wants you to have at least a 6% balance. That's the magic number.
Say that again.
For any type of regular lending product, credit cards, right, to have the best credit score or at least not get penalized is 30%. $1 over 30%, that's a penalty.
Got it.
The more you spend over that 30, the higher the penalty is, right? However, for a mortgage FICO inquiries, so if an investor comes to you today and says, hey, I want to pull credit, I would, to get the best interest rate, I would recommend that they keep each credit card below or at a 6%. Not zero balance, not 10%, not 20, not 30, 6%.
6, like one number above 5, a number below 7.
6%.
So you're telling me when I go apply for a mortgage, before I apply for that mortgage, I want to make sure that all my credit balances on my credit cards are at a 6% utilization to get the best score.
That is correct.
6%. That is
20
crazy.
years of the industry and every research we make is to get clients to the better credit scores. And yeah, 6% seems to be the magic number.
So let's talk about, okay, let's say I am getting ready to go get a mortgage. I know I want my utilization at 6%, in particular for a mortgage credit inquiry. So I look at all my statements and I'm like, oh, this one's at a 10% utilization. I'm going to pay 4% down on this one. And, oh, this one's a little high. I'm going to pay that one down. Great. Now I'm ready. How soon do I have to wait to go get my credit check before I receive the benefits of that?
Your Wells Fargo credit card, just to use it as an example, Wells Fargo reports to the 3 major credit bureaus, which are Experian, TransUnion, and Equifax. Wells Fargo pays a membership to report your on-time payments, your balances, everything you do with that credit card is reported on the credit bureau level. Wells Fargo, because they make the decisions as to when they would like to report your balances, that's where it gets tricky. Because if you pay on your credit cards today, it doesn't mean that the credit bureaus have the information that you've paid it today. You have to wait until Wells Fargo reports it to the bureaus, and that's when the bureaus update their credit score. So it's not your statement date. It's not your due date. It's the date that they report to the bureaus, which typically happens at the beginning of the month. It could vary. It's entirely up to the creditor when they want it.
So essentially, I post payment and I have to wait at least probably a month to reflect the score. So what happens if it's like the end of the month? Let's say it's 25th of October, for example, and I look at my credit utilization, I pay it down, the next month rolls over. Do I get the benefit of that or do I have to wait another month?
So you pay the credit card today. It's at 6% utilization. Today's the 25th. Wells Fargo reports on the 5th. On the 5th, whatever balance you have on the 5th, that's when the bureaus will update your scores. So just to clarify, you can pay your credit card today. But if you use it again, and on the 5th, Wells Fargo reports, Wells Fargo's going to report whatever balance you have on that date, and the bureaus will update the score to the balance the creditor provided them.
Interesting. So we want to be getting ready. We want to be getting in the gym before we're ready to go. So this is really helpful because sometimes people call last minute. They're like, I need a mortgage. Interest rates are so crazy and they need all this credit help. These are things that we can be doing in advance when we know that we want to start buying to make this process easier, to give you better interest rates, to just make your life better. Honestly, this is information. I'm in the industry. This is information that some of this information is new to me today on this call. And it's really, I have no doubt that other people are going to benefit the same amount as I am from asking these questions. Because how often do you get to dig in to something weird like a credit score?
It's crazy because some people don't even know what their credit score is. How many times has that happened?
Oh, yeah. Most people, I ask everybody, do you have any idea of what your credit score is? No clue. They don't even know what's a good number or what's not a good number. You know, I had, I pulled a credit score one time. It was like 450. And, you know, not to laugh at the score, but I was like, hey, you know, I want to let you know that you have a 450 credit score. And they were stoked. They were like, oh, that's awesome. That's really good. You know, that's so good. And I had to explain to them what the numbers were, what we're shooting for, what I'm allowed to lend on. But that's a good point. So a credit score, let's talk about scores. What does scores mean? Let's talk numbers.
Basically, the 3-digit number means your capability of paying back debt on time and in full. In full means if your auto loan payment is $500 a month and you only pay $480, you're $20 short. That is not in full. That would be considered a late payment.
Now, is in full considered the minimum monthly payment? How does that work? Because I know when I get a credit card statement, it's like, here's how much your balance is. Here's the minimum required payment. Is that what you're talking about?
Yeah. So in full means at least the minimum. But from a financial perspective, you never just want to pay the minimum because that's how interest rates rack up. Like it's a snowball effect. You may think, hey, I got 21 months, no interest. I'm just going to pay the minimum month to month. I'll pay this back later. Like you probably know, and you and I know this because we're in the industry, but many listeners don't know is that if you don't read the fine print, it very clearly specifies that if you don't pay back the debt you used within those 21 months, right? The 22nd month, you're going to get hit with interest for the 21 months you didn't pay interest on.
Yeah, so that debt needs to be paid in full. And that's how a lot of credit card companies get you with those 0% cards. And when I said that 0% card, I'm not using that card to just keep a balance. I'm using that card as actual cash temporarily. So I don't have to come out of pocket because what I'm using it on is going to generate income. That's an advanced credit strategy. I would not advise somebody who's not experienced in using leverage and using credit to do that whatsoever. Once you know how to use credit, it becomes a very powerful tool. But yes, definitely. Thank you for clarifying that. I'm not advocating the use of something like that until you're ready to use that. I want to talk numbers. So what's a good score? What's not a good score? What numbers get you access to what?
Yeah, I mean, if you don't have an 850 credit score, 800 credit score, don't feel disencouraged. My mom, who's 65 years old, does not have an 850 credit score, and she's been building credit forever. She's never missed a payment. Now, to get qualified for a mortgage, and this is maybe something that you can specify on like what's the minimum credit score criteria, but if you have over a 700 credit score, you could be considered a decent borrower. Maybe you're lacking length of credit history. Maybe you're lacking a diverse portfolio. So the credit score, just take it with a grain of salt because there's just so many other things, but do focus on your history and behavior as a borrower. Because you may be an individual who only has 3 months of credit history, but you've paid all your bills on time. That's going to eventually lead to an 850. But you can get a mortgage with a 580. Doesn't mean you can't buy a house, just it's a higher risk.
Yeah, that is true. And there are other loan programs like VA, for example, technically doesn't have a credit limit requirement. You can have a pretty low score. Now, there's things that go into that, and there's different cycles of borrowing where investors may say, yes, technically the guidelines say you can have a lower credit score. However, because you're a riskier borrower, we're not approving this, and we're not going to let it get underwritten. And even if the rules say you can have a lower score, you always benefit from having a better score because you're going to get better opportunity, better access to lower priced interest rates, which make your mortgage payment much lower. But just as a generality, we'll talk, just general credit scores. For a conventional loan, you need to have a score of 640 or better for most investors. FHA is, 620 to 640. There are some products that allow a 580, and then, same thing with VA loans, but always, the better credit score you have, the less you're going to pay. And so why would you not want to pay less on your mortgage, right? These things are interest rates right now are obviously a little bit difficult and they're expensive. And so let's get you the best pricing possible. Do you know much about how like an 800, why is it an 800? Why not just like 1 through 10? Do you know much about the numbering system or?
That's a very interesting question. So it's really interesting because when we're talking about like credit score numbers, right? It was just a system that the bureaus generated, and there's more than three credit bureaus. There's small credit bureaus that we don't even talk about, but in general, they just sat down and said, "Hey, this is what the scoring model is going to be. It's going to start at a 350 to 580. They're going to be, they just literally sat down and decided that's what it was going to be, and that's what it is."
Let's talk credit inquiries. How does this impact your credit score? What's the difference between a hard pull, a soft pull? How long does that impact your score? What kind of a difference does that make on your score?
Yeah, so hard inquiries is anytime you apply for new debt, credit cards, personal loans, auto loans. A soft inquiry is when a company or an institution is looking at your behavior in regards to your finances to determine if you could get a lease, for example. When you try to rent an apartment, they don't do a hard inquiry because you're not borrowing money. Hard inquiries, they stay physically on the credit report for 2 years. However, the impact is only for 1. How does the system determine how to penalize you? Because there is a penalty, unfortunately. The penalty is anywhere between 2 to 6 points. Now, if I'm an individual who rarely applies for credit, I may be penalized on the higher end. So if I haven't applied for anything in 2 years and I say, "Hey, Tim, I'm ready to buy a second property. Help me out." And you pull my credit because I haven't had one in 6 months, in 2 years, I'm probably going to be penalized about 6 points. That's the maximum. But if I'm the kind of borrower that likes to open credit cards, new auto loan, and on a yearly basis, I have 6 inquiries, the system likes to make it fair. So you're going to be penalized on the lower end, maybe 1 point, 2 points. So it's not negatively impacting you as much.
Let's say you're shopping for a home, all right? And you're shopping, let's say you're shopping interest rates. And so every time you go to a mortgage lender, or you're shopping for a car and people are running your credit and you get 5 people running your credit in a small block of time, does that mean that the 5th person that's going to run my score, I'm down, 6 times 5, 30. Let's say, am I down 30 points? And I know the answer to this, but I want you to tell the audience, how does this impact your score? Is there a window? How long does the window last? And then do the points accumulate outside that window?
Yeah, so there is a shopping window. The shopping window is specific to the industry. If you're trying to get into a house, you have 14 days to shop around for the best rate. On the 15th day, if another lender, mortgage, or different industry looks at your credit, it will be a penalty then. It would be considered as a new inquiry that's penalized. All of the ones you did in 14 days will physically show. Because if I go to different lending mortgage companies, every mortgage lender will see how many times you've been applying. Now, if I go and apply for a credit card within the 14-day window, that's a completely different industry. That's going to be another penalty, even though it's within the same 14 days.
Okay, so in the example I gave you of you're shopping for a mortgage, and we go to 4 places and it's 6 points per hit, but I'm within my shopping window, those points are going to fall off at the end of the year on my credit report. However, once that 30-day window expires, all those points are going to accumulate, or just one 6-point hit are going to accumulate?
Just one 6-point hit.
Really?
Yep, and it's 14 days. So 14 days to shop around, whatever you think would, you want to see who's got the better price, the better product. But if you do it multiple times, all of them will show, but you're only going to get dinged once.
Okay. So within a 14-day window, it's like you can shop as much as you want within 14 days. And then after 14 days, you're only going to get dinged with that one inquiry. It's not going to count as 4 separate or 5 separate inquiries. That's good to know. Okay, let's talk about co-signing. And there's 2 scenarios I can think of for adding co-signers. One is a brand new credit user, 18-year-old, wants to build credit. You could add them as a authorized user or co-signer. The other is if somebody needs credit help and they have a bad credit history, bankruptcy, something like that, which we should talk about quickly, bankruptcy. I've heard of people adding bad credit users as an authorized user, not giving them a credit card to go charge things up, but just adding them as an authorized user to help build their score. What does that do for the person that's getting added? And if the person that's getting added has poor credit history, does that impact me as a good borrower who adds them as an authorized user?
Yeah, so you add me as an authorized user. You have perfect length of credit history. You add me on a credit card that's been opened for 10 years, right? Those 10 years of positive history will now be added to my Social Security. I benefit from you. Absolutely nothing happens to you or your social or your credit card. Unless you give me the physical credit card, then I may go out and shop a little bit, but that's if I use your credit card, I will be using your utilization as well. And then we would mutually both benefit or not benefit from it, right? Now, when we think about authorized users for those borrowers that have, difficulties with their credit, think about a scale. So you have all of these derogatory items, collections, late payments, bankruptcies, repossessions. It's scaling you down because the negative's heavier than the positive. But then when you add me to a 10-year-old credit card with on-time payments for, how many months? Like forever, it's going to start weighing down the negative. So it starts evening out, but it's never going to be 100-point increase by being added as an authorized user. Potentially, it could be 100 points if I don't have a single credit card open because I'm missing 30% of my points. So when you add me, I acquire 10 years of length of credit history. I acquire 10 years of positive on-time payments. I acquire your 30% or below credit utilization, and your credit stayed the same. I benefit.
Interesting. So that's good to know. That's a great strategy to help somebody build a credit score that needs a higher credit score. Let's bring this home. Let's end with delinquencies. So there's what's known as a charge-off, which is essentially the company who's coming after you for collections just says, we're never going to get this money back from you, whatever. It's a wash, but we're hitting you with a charge-off on your credit report. And then delinquencies and serious delinquencies. How do these impact our credit score? And also, I've heard of people calling credit companies and negotiating and saying, hey, listen, I will pay you, but before I give you payment, I want you to remove this from my credit report. Can you talk about that a little bit?
Yeah, so a collection, a charge-off, that's the worst penalty an individual could have. It means you didn't care. This is what the credit bureaus think. You didn't even care to pay back on this debt, so we're going to penalize you as much as we can. The penalty on a collection account is 7 years. And what people don't know, because most individuals don't have access to properly monitor their credit and get proper information in regards to their situation, but it's the day of last activity. So if it's a 7-year penalty on a collection account, and the day of last activity is the date that the bureaus use to penalize you, the more recent it is, the more harmful it is to your credit. So a collection account that hits you today, that's horrible for you. It really impacts you. A collection account from 5 years ago, it only has 2 years left. Now, individuals don't know, and this is where I want every listener to pay attention. A payment is considered an activity. So many people think they go to you and say, hey, Tim, I can't qualify, but I did the right thing. I paid all my collections. I paid all my bills. Am I ready yet? You repull credit. All of a sudden, the credit scores went down and you're like, wait, what happened? You pay your bills. I don't get it. The 7-year penalty just refreshed and your credit score dropped. Unless you get a deletion letter, because you can settle on debt. You know, if you're able to settle, it's a $0 balance that you owe Wells Fargo, that you owe Portfolio Recovery, Allstate. You don't owe them money. If you pay in full, it's the same impact. But you have to think about when was the last time the account was updated on a credit bureau level, and unless you get a deletion letter. So yes, some creditors will say, if you pay me back the debt, I promise I will delete this off the credit report, eliminating the derogatory information, giving you back the credit worthiness. But if you don't get a deletion letter, all you really did was pay on the debt that ultimately dinged your credit even more for another 7 years when potentially it could have fallen off your credit naturally within 2 years.
That is crazy information. If you make a payment, I always wondered, like, why can't we just make a payment for derogatory credit? It's activity. Even if there's no more balance anymore, it restarts the clock. So here's what I want to end with. Okay, this is a lot of information, and there is no way there's information that we didn't even have time to cover today. Unless you listen to this episode on repeat every single day, there's just no way. You just cannot, as an individual, understand this process. And that's why I wanted you to bring it home, because this is exactly what you do. You take a borrower, you have all this expertise and knowledge, and you help them improve their scores. You get a plan for them. You make tweaks on their credit report, on their file, to improve their scores and get them where they need to go. And I would just love if you could tell the audience what you specifically do and how we connected.
Yeah, I mean, Yokel has been around for so many years. We're a mortgage-driven industry with the ultimate goal to educate you, get you to point A to point B by understanding what happened in point A that let you to not having perfect credit scores. So we can help you with budgeting. We give you identity theft protection. There is actually a federal law, which most of you guys may not even know about. It's called the Fair Credit Reporting Act. And this is a law that states that everything on your credit report has to be 100% accurate, verifiable, and complete. So yes, Tim, that Allstate collection that you never paid back, that might have been your account. That is true. But do the bureaus have your complete compliance documentation to keep that on a credit bureau level? If they can't verify your info within 30 days, I'm sorry, credit bureaus, but you must delete that info, giving me back the credit worthiness. So we specialize in helping you provide the tools to everything that will help you succeed financially and get you to better credit scores. Because, of course, most of you guys want to be home buyers. You want to be, have ownership of something that belongs to you. But your car insurance, your cell phone bill, everything that you may not even think about is actually related to your credit score. Like, you may even have to put a larger deposit down on an apartment if your credit's poor. So think about the different things that you're paying extra on because of the lack of knowledge that you have in regards to your finances in your credits.
Yeah, this is excellent. And everybody that comes to me that needs credit help, I obviously will be sending to Danny, and I have done so in the past, and that's why we got you on the show. And I'm going to include all of Danny's information on the show notes below. So make sure you scroll down, click on her information. And where can people get a hold of you?
Yeah, they can call me, they can text me, they can email me. My email address is my first name, Daniela, Daniela .Torres, Torres @uqual.com, uqual.com. My phone number is 720-647-2901. And anyone that's listened to this podcast today, I am happy to give you guys a free consultation just to get you guys into the right path of understanding your finances and credit.
That is amazing. Just tell her that you came over from the Dynamist podcast, and I really, really appreciate this. This has been super, super informative. I learned a lot. I'm not embarrassed to say there's things that I learn even in an industry that I work in regularly. So thank you for coming on, and I look forward to connecting with you again. I know there's more questions that we have to answer. To everybody listening, thank you for sticking around. I hope this was helpful. Give us a 5-star review if you like this show. Follow us, tell your friends, and we will catch you on the flip side.